Welcome to the Deep Dive, where we cut through the noise to bring you the insights you need to truly stay well informed. Today, we're jumping into a really fascinating deep dive into the world of financial markets.
That's right. We're going to be unpacking a pretty comprehensive analysis, drawing directly from a recent weekly live stream, this one published on July 7, 2025. In this report, it offers a really in-depth look at current market dynamics, trading strategies, and critical cross-asset correlations, insights you typically see reserved for sophisticated investors.
Okay, so that means we'll be exploring everything from Bitcoin to U.S. equities, major indices, even gold, really focusing on what's driving prices and where significant opportunities might be, well, emerging. Our mission today is to extract the most important nuggets of knowledge from this material and help you understand the powerful forces at play in what our source is calling a potentially melt-up market environment. Okay, let's unpack this. All right, to kick things off, let's dive into a powerful technical trading framework. It's known as the monthly open strategy. So what is this strategy exactly, and why is it so pivotal for, understanding where the market might be headed?
Well, basically, this strategy leverages the opening price of a new monthly candle. For those less familiar, that's just the first price traded right at the start of a new month. You often see it visualized as a yellow dotted line on a daily chart, and it acts as a critical support or resistance zone. So by watching how price reacts to this level early in the month, traders can get a feel for whether the market's establishing a bullish or a bearish bias.
Okay, right. So if prices move down immediately after that monthly open, what does that tell us? I mean, is that a sign of weakness?
Not necessarily, no. It often signals that the market is actually forming the lower wick of the monthly candle, so potentially setting the month's low before a reversal. Traders, they aim to identify this low point to enter long positions, buying with the expectation prices will rise and capture that subsequent upside momentum. We look for confirmation patterns on shorter time frames, maybe weekly or 2-week charts, things like an inside candle.
That's the consolidation one, right?
Exactly, where price holds entirely within the previous candle's range, or a swing failure pattern, an SFP. That's where price briefly pushes beyond a key level, like support or resistance, only to sharply reverse. It essentially traps traders on the wrong side. These are really strong signals of an impending shift.
Okay, yeah. And that example with Bitcoin back in April, that really paints a picture. Can you walk us through that again just to see it in action?
Absolutely. So consider Bitcoin's price action in April 2025. The April candle, it opened at $82,537. Now, Bitcoin initially dropped. It failed to break the high of an inside 2-week candle and then moved lower in a significant flush. It was targeting stop losses below key levels, taking it down to around $76,606. If you looked at the hourly charts, prices tested the monthly and weekly opens, consolidated a bit, and then, bam, collapsed to a low of $76,600. And right there, it formed a daily SFP, that swing failure pattern. That SFP signaled the downside likely formed the monthly candle's lower wick, and that was followed by a reversal, confirmed by a big bullish engulfing candle.
Right, where the green candle just swamps the previous red one.
Exactly, showing strong buying pressure coming back in.
That sounds like, I don't know, a sophisticated game, almost like a calculated move by the bigger players. How does the source suggest maybe a less sophisticated investor can spot these moments, or even protect themselves from getting swept out?
That's precisely it. It is often a calculated move. Large players frequently manipulate price to clear out stop losses, those automated sell orders, right, before they reverse direction. It's all about sweeping liquidity. Gathering up all those sell orders to fuel their own buying. The key insight here is that the breakback above $82,537 after sweeping that liquidity, that confirmed the monthly bottom was likely in. And that led to an expansion upward, all the way to $94,422 by the end of the month. Our source material highlights that this strategy, especially when combined with these specific patterns like SFPs and engulfing candles, can have a really high strike rate, maybe 90–100%. Because it's about figuring out the intent behind the price action you see, not just predicting a number. It's anticipating those institutional moves.
Okay, so if the monthly open helps us see where institutions are pivoting and maybe trapping traders, what about a pattern that signals where they're quietly, accumulating positions before a really explosive move? That brings us to another fascinating concept from the source material, the rainbow pattern. Sounds visual. What is it and what does it signal?
Yeah, it is visual. The rainbow pattern is a proprietary technical indicator, and it signals extreme price consolidation and an impending explosive move. It happens when the daily, weekly, and monthly opening prices all align within a very narrow price range. So you get this visually distinct rainbow of stacked levels. typically daily in green, weekly in red, and monthly in yellow. Imagine those three starting lines just stacked almost right on top of each other.
Okay, wow. So when we see that kind of tight alignment across different time frames, what's the market really telling us about the underlying dynamics?
Well, it reflects significant institutional accumulation. You've got large players building their positions during these periods of very low volatility. They're basically coiling up, getting ready for a significant breakout. Now, according to our source, the pattern has about a 70% probability of breaking to the upside, but, downside moves are still possible. The real challenge for traders, though, is spotting these levels in real time as they form. Because once the price expands and moves away, these rainbow levels kind of fade into the chart background. It's really about catching that moment of calm before the storm.
Right. Can you share maybe a historical example where this pattern was really clear and what it meant for the market?
Certainly. November 2024, the Nasdaq. That provided a really clear precedent right around the U.S. presidential election. After a sharp but kind of contained crash from 20,600 down to 19,900, Nasdaq entered this phase of extreme consolidation for about 3 or 4 days, and its daily, weekly, and monthly opens were tightly stacked, a perfect rainbow pattern. Then on November 5, 2024, right after the election results started coming in, Nasdaq broke decisively above those stacked opens and its near swing high. That triggered a strong long signal.
And the outcome of that signal?
It led to a really explosive upside rally. The position performed strongly all through November, hitting new all-time highs by December 2nd, 2024. So this example, it really highlights how the rainbow pattern can flag these high-probability trades, especially when they align with major macroeconomic catalysts like election results. It's that calm before a potentially big move.
That NASDAQ example definitely showcases the power of the rainbow pattern, identifying those major breakouts. So with that framework in mind, let's turn our attention to what this analysis suggests for a major player like Bitcoin right now. Here in July 2025, what's Bitcoin's current setup looking like? Is that rainbow pattern in play?
Yes, it is. As of July 6th, 2025, Bitcoin's trading above its June monthly open, which was $107,164. And it's supported by a pretty robust technical setup. We are indeed seeing a clear rainbow pattern forming. You've got multiple support and resistance levels converging right around that $105,000 to $107,164 area. These levels include the weekly open, the daily open, the monthly open, even the prior month's open, all stacked up. Prices have tested these levels, bounced off them, and then broken above. That signals strong institutional accumulation during this consolidation phase, much like we just discussed.
Okay, so given that accumulation, what are the potential upside targets for Bitcoin this month for July, according to the source?
Well, the primary targets mentioned are $115,000. That's seen as kind of a minor target, maybe achievable within 1 to 2 weeks. And then $118,776. That's viewed as the more realistic target for July itself. It aligns with a 1.272 Fibonacci extension level. There's talk of a rally to $130,000 as a longer-term target, but the source suggests that's probably not feasible just for July.
And what about the broader market? Is Bitcoin still kind of marching to its own drum, or is it more connected these days? What's the influence there?
That's a great question, and it's really key to understanding Bitcoin's maturation, I think. So July is historically a pretty bullish month for equities, particularly the Nasdaq. And the Nasdaq has actually gained about 8% in the past month, while Bitcoin, it remained relatively sideways. Bitcoin's price action is now showing a close correlation with the Nasdaq, which suggests that a continued Nasdaq rally, maybe towards that 24,000 level, will likely help drive Bitcoin toward its own upside targets. This increasing correlation, it really reflects Bitcoin's evolution, moving from a niche crypto asset to something behaving more like a mainstream asset.
Okay, interesting. And is Ethereum showing similar patterns? Is it mirroring Bitcoin in this current environment?
Yes, it is. Ethereum mirrors Bitcoin's setup quite closely, actually.
Okay.
It also exhibits a rainbow pattern. You've got its monthly open around $2,485, the weekly open near $2,500, and the prior month's open at $2,529, all creating a tight range. Ethereum also recently swept downside liquidity.
Dip down to trigger stops.
Exactly. Dipped briefly, likely triggering stop-loss orders for traders positioned short, and then quickly reversed upward. And in doing so, it formed what's called a bullish order block just below these key levels. Think of an order block as a distinct zone on the chart where significant institutional buying interest was concentrated. It can act as strong support later. So this whole setup really reinforces the bullish bias for Ethereum as well.
So it sounds like another strong, long opportunity for Ethereum, but the source material also touched on portfolio allocation. What's the takeaway there for listeners thinking about these opportunities?
Right, yeah. While Ethereum certainly presents a viable long opportunity based on this setup, The source does note that the example portfolios discussed are heavily allocated to equities right now. And this highlights a really important aspect of portfolio risk management. You need to ensure diversification and avoid getting over-leveraged, especially in markets that are highly correlated. It's just a reminder that even if you find a strong individual setup, you need to consider it within the context of your overall portfolio strategy and risk.
That correlation with the Nasdaq is really fascinating. It sounds like Bitcoin isn't really flying solo anymore. What does this increasing linkage with an index like the Nasdaq mean for investors, maybe like you, especially thinking about its long-term stability?
Well, it reflects Bitcoin's evolution into a more mainstream asset class. It's behaving more like a risk-on equity, meaning it tends to do well when the broader stock market is doing well, rather than acting completely independently. This linkage, arguably, ensures more long-term stability for holders, almost like a form of digital gold, perhaps, but with a different risk profile tied more to general market sentiment.
Right. And I remember you mentioned a shift of capital recently from crypto to equities. That idea of finding the best bang for the buck, why was that move happening?
Yeah, exactly. So from around May to July 2025, U.S. equities significantly outperformed cryptocurrencies. Crypto was generally trading sideways, maybe even slightly down. For instance, NVIDIA gained a remarkable 22% just since May 13, 2025. Compare that to Bitcoin's relatively flat performance over the same period. So this prompted a strategic reallocation of capital, moving towards equities to capitalize on what looked like stronger technical setups in stocks like NVIDIA, Apple, and Amazon. The underlying principle is always evaluating where your capital can generate the most efficient returns, right? Understanding how money flows dynamically across different asset classes based on the relative strength and opportunity at that moment.
Let's talk about Apple then, a giant in the equity space. What's driving its current momentum, especially considering some of the recent headwinds it faced?
Apple is definitely a significant focal point right now, largely due to its sensitivity to U.S.-China trade dynamics and, of course, its massive weighting in the major indices. If you remember, back in April 2025, Apple saw a notable drop from 225 down to 207, and our source specifically attributed that to President Trump's tariffs on China. However, there's anticipation of a potential U.S.-China trade deal, maybe around July 9th, 2025. And if that happens, it could reverse this decline, filling what traders call a price inefficiency back up at the 225 level. That represents a potential 6% upside from current levels.
Okay. And technically speaking, beyond those potential political catalysts, what's its chart telling us?
Well, technically, Apple is breaking out in something called a triple inside weekly candle.
Triple, wow.
Yeah, it's quite rare. In a powerful pattern indicating strong bullish momentum. It basically means the price action for 3 consecutive weeks stayed entirely within the range of the week before that. So, super tight consolidation before a potential breakout. This actually mirrors a scenario back in 2013 where Apple gained something like 38% after a similar consolidation pattern. Plus, Apple's earnings are due on July 31st, 2025. That's another significant catalyst on the horizon, likely to amplify this breakout if it continues.
Okay, interesting. Now, moving over to crypto equities, how is Coinbase positioned, especially in light of something called the Genius Act?
Ah, yes, the Genius Act. Passed in 2025, according to the source. This is seen as a major game changer. It has specifically enabled the mainstream adoption of stablecoins, those cryptos pegged to the US dollar, by providing much-needed regulatory clarity and infrastructure. And this has apparently revolutionized transaction efficiency. Coinbase is positioned at the forefront here. Their stablecoin transactions reportedly cost just 1% in fees, which is a stark contrast to the 3–4% often charged by traditional platforms like PayPal. So this efficiency, it poses a profound threat to traditional global financial payment systems. And technically, Coinbase's chart shows an inside quarterly candle failure.
Okay, similar pattern again, just longer time frame.
Exactly. Price initially tried to break down from a 3-month consolidation, but quickly reversed, trapping sellers. That signals further upside potential, which naturally supports Bitcoin and other crypto equities too.
Now, here's something that seemed really unexpected in the source material. This surprising correlation pointed out between Bitcoin and, of all things, JP Morgan. How does that make sense? They seem like such different beasts.
It truly is a surprising insight, isn't it? And it really highlights just how interconnected markets have become. So since January 2023, Bitcoin has surged an astonishing 568%. But what's wild is that it closely mirrored JP Morgan's price action over that period. JPM itself rose 265%, actually outperforming some of this so-called Magnificent Seven tech stocks. And get this, Both assets formed inside two-week candle failures back in November 2022.
The same pattern at the same time?
Pretty much. Price tried to break lower from a two-week consolidation, then quickly reversed. It reflects their underlying linkage, likely through the Nasdaq and broader U.S. equity sentiment. And according to the source, J.P. Morgan's current chart, showing a strong up candle, signals that Bitcoin's own imminent expansion is likely. It's a fascinating connection.
Wow. So what does this unexpected correlation imply for Bitcoin's long-term outlook, especially when you compare it to a traditional giant like J.P. Morgan?
Well, the source projects Bitcoin reaching $1 million by 2028. That's roughly an 8x return from current levels, potentially hitting a $16 trillion market cap. Now, compare that to J.P. Morgan's expected growth over the same period, maybe 100, 150%. So the potential upside for Bitcoin is still seen as much greater. Bitcoin's smaller current market cap, around $2 trillion now, still offers significantly more growth potential. And it's anticipated, according to this analysis, to become the crypto market's benchmark index, much like the S&P 500 functions for equities.
Okay, let's broaden our view then to the overall market. What are the big indices, the S&P 500 and Nasdaq, telling us right now about the general market sentiment?
Well, the S&P 500's recent performance has been remarkable, marked by 10 consecutive bullish daily candles recently. That signals really robust momentum. It strongly resembles the kind of recoveries we saw post-COVID and after the 2018 crash. The market is currently on its third straight bullish monthly candle, which suggests there might be further upside before we see any kind of, euphoria-driven corrections.
And how is U.S. policy feeding into this? It almost sounds like the market's getting a huge tailwind from new legislation mentioned in the source.
It certainly seems that way. July's normally strong seasonality appears to be significantly amplified by this Invest in America Act, which the source says was signed into law on July 4th, 2025. Now, this act allocates $1,000 S&P 500 accounts for every child born from July 4, 2025 onward. This isn't just symbolic. It's designed to inject roughly $70 billion into the S&P 500 by July 4, 2026. That creates a sustained significant liquidity tailwind for the market, kind of like the effects we saw from those post-COVID stimulus packages. The source indicates the S&P 500 is already up 6% year-to-date and is targeting maybe 18–20% by year-end, which they attribute in part to President Trump's pro-market agenda.
Right. And what about the Nasdaq specifically? Its technical patterns and any upcoming events we should be watching?
Nasdaq's technical setup also unequivocally supports continued upside, really driven by this potential melt-up environment. There was a recent inside daily candle failure. Similar concept, just on the daily time frame signaling bullish continuation. Now, Friday saw some downside, likely due to the U.S. holiday, but a potential dip on Monday, maybe down to 22,617, could test the monthly open. That might offer a strong long entry point, according to the analysis. And of course, we have key earnings coming up thick and fast. J.P. Morgan on July 15th, Nasdaq itself on the 17th, Microsoft Google on the 29th, Amazon Apple on the 31st, and Tesla sometime in late July. Those will undoubtedly bring volatility, but the overall upside trend is expected to persist through it. Nasdaq's looking at maybe 7–8% upside, targeting 23,855 to 24,000.
Okay. And are other global indices showing similar positive trends? Is this bullishness widespread?
Yes, it seems so. Both the Dow Jones and the Nikkei in Japan are signaling upside as well. The Dow Jones shows an inside two-month candle failure. Again, attempting to break lower from a two-month consolidation, but reversing, suggesting about 2.6% upside to reach all-time highs. The Nikkei shows an inside quarterly candle failure, suggesting an even larger potential upside of 8.5%, and it correlates strongly with the Nasdaq and the SMH semiconductor ETF, likely influenced by NVIDIA's global footprint. So these patterns are pretty consistent across the board, pointing towards continued strength.
Okay, finally, let's just quickly touch on forex and gold. How do they fit into this whole dynamic market picture, maybe as hedges or alternative plays?
Right. Well, USD/JPY currency pair, its technical setup, particularly something called a double inside monthly candle, is seen as supporting broader market trends. A breakout there is considered high probability and would likely help lift the Nikkei index. Now, for hedging against potential USD devaluation, which can obviously erode portfolio returns if you're holding USD assets, our source suggests short-term SPY option calls. Those are contracts giving you the right to buy the S&P 500 index ETF at a set price. They see this as a way to potentially boost a portfolio, maybe yielding 100–150% returns quickly. Of course, alternatives for hedging also include gold and Bitcoin longs. Gold itself is showing an inside two-month candle failure, targeting a liquidity level down near 3,120. It's generally expected to outperform into the year-end, especially in the last two quarters, acting as that traditional safe haven asset amid potential USD weakness and any ongoing geopolitical uncertainties.
Wow. What an incredibly detailed and really insightful deep dive. We've covered such dynamic market environment predicted for July 2025, driven by these unique technical patterns, significant policy support, and those substantial liquidity injections. It really helps make sense of the market's potential trajectory.
Indeed, I think the insights from this source material really emphasize the critical importance of, well, active portfolio management. We've seen how strategies like the monthly open and the rainbow pattern, along with really understanding those cross-market correlations, can potentially offer high probability setups,
Yeah.
whether it's in cryptocurrencies, major equities like Apple, or the broader indices like the S&P 500 and Nasdaq.
Right, and it's not just about chasing gains, is it? It's also about smart risk management, defining your exits clearly, and considering those hedges like gold or maybe strategic forex plays to balance out portfolio volatility. The Invest in America Act and those other anticipated policy shifts, they're clearly creating some powerful tailwinds, according to this analysis.
Absolutely. And this all raises, I think, an important question for you, the listener, to consider. In a market apparently driven by such powerful institutional flows and these very specific technical signals, how might understanding these underlying dynamics fundamentally change your approach? Your approach to information and decision-making, not just in finance, but really in any complex system you encounter.
Something to definitely think about. Keep those questions brewing, and please join us next time for another deep dive.